1. Balance of trade and balance of payments, understanding international transactions. The balance of trade signifies the disparity between the value of tangible goods, exports and imports, as well as intangible services traded by a nation. In contrast, the current account encompasses a broader spectrum of transactions, encompassing goods, services, income, and transfers occurring between a country and the rest of the world. Moreover, the capital account focuses on the transfer of capital and the acquisition or disposal of non-financial assets. When we consider all international transactions together, including the current account, capital account, and official financing account, we arrive at the balance of payments. It is worth noting that balance of payments disequilibria occur when there are imbalances or deficit surpluses in the overall balance of payments. This term refers to situations where there are disparities in the flow of funds between countries due to discrepancies in their trade, investment, and financial activities. Such disequilibria can have various implications for the economy and are often closely monitored by policymakers. Tariffs, taxes on imported goods. Tariffs are government-imposed taxes or duties placed on goods that are imported into a country. These charges are typically levied as a percentage of the value of the imported goods. The primary objective of tariffs is to protect domestic industries and stimulate the local economy by making imported goods more expensive compared to domestically produced alternatives. Tariffs can also serve as a source of revenue for the government. Common external tariff, CET uniform tariffs in a customs union. A common external tariff, CET, refers to a standardized tariff rate that is applied uniformly by a group of countries within a customs union. A customs union is a form of regional economic integration where member countries eliminate internal trade barriers and adopt a common external trade policy. This means that when goods are imported from outside the customs union, they are subject to the same tariff rate set by the CET. The purpose of implementing a CET is to create a level playing field for member countries and establish a unified approach to trade with non-member nations. Quotas, limiting imports. Quotas are non-tariff barriers that impose restrictions on the quantity or volume of imports allowed into a country. Unlike tariffs, which impose taxes on imported goods, quotas directly limit the physical amount of imports. They can be set as absolute limits on the quantity of specific goods allowed into a country or as a percentage of domestic consumption. Quotas are often used to protect domestic industries from foreign competition or to manage the supply and demand of specific goods in the domestic market. By limiting imports, quotas aim to support domestic production and safeguard national interests. Exchange rate, determining currency conversion. The exchange rate is the price at which one currency can be exchanged for another currency. It reflects the value of one currency in terms of another and plays a crucial role in international trade, investment, and financial transactions. Exchange rates are influenced by various factors, including supply and demand dynamics, economic indicators, interest rates, geopolitical events, and market sentiment. Fluctuations in exchange rates can have significant impacts on the competitiveness of exports and imports, the profitability of multinational corporations, and the purchasing power of individuals engaged in international transactions. Exchange rate regimes, systems governing currency values. Exchange rate regimes are frameworks or systems that govern how exchange rates are determined. They provide a set of rules and mechanisms for managing currency values. Different exchange rate regimes exist, each with its own characteristics and implications. Some common exchange rate regimes include 1. Fixed exchange rate. Under a fixed exchange rate regime, the value of a currency is pegged or fixed to another currency, a basket of currencies, or a commodity like gold. Central banks or monetary authorities intervene in the foreign exchange market to maintain the predetermined exchange rate. This regime provides stability and predictability in currency values but may require significant reserves and intervention efforts to sustain the fixed rate. 2. Floating exchange rate. A floating exchange rate regime allows currency values to be determined by market forces of supply and demand. The exchange rate fluctuates freely based on various economic factors and market expectations. This regime offers flexibility and can automatically adjust to changing economic conditions. However, it can also result in volatility and uncertainty in currency values. 3. Managed exchange rate. A managed exchange rate regime is a hybrid approach that combines elements of fixed and floating exchange rates. In this system, authorities intervene in the foreign exchange market to influence or manage the exchange rate within a certain range or band. They may use various measures, such as buying or selling currencies, implementing capital controls, or adjusting monetary policies, to maintain the desired exchange rate level. The World Trade Organization, WTO, promoting fair global trade. The World Trade Organization, WTO, is an international organization that serves as a platform for negotiating and enforcing global trade rules among its member countries. It aims to promote free and fair trade by reducing trade barriers, eliminating discriminatory practices, and providing a framework for resolving trade disputes. The WTO facilitates negotiations on trade agreements, establishes principles for non-discriminatory treatment, and provides a platform for member countries to discuss and address trade-related issues. It plays a crucial role in fostering international cooperation, promoting economic growth, and ensuring a rules-based global trading system. 2. Comparative advantage, enhancing international trade and economic welfare. The concept of comparative advantage elucidates the underlying principles and reasoning behind engaging in international trade. According to this concept, countries should allocate their resources and specialize in the production of goods and services in which they have a comparatively lower opportunity cost compared to other countries. Opportunity cost refers to the potential loss of producing one good or service when resources are instead allocated to the production of another. By focusing on producing goods or services that have a lower opportunity cost, countries can optimize their resource allocation and efficiency. This specialization allows countries to exploit their inherent strengths, whether it be access to natural resources, skilled labor, technological expertise, or economies of scale. When countries specialize based on their comparative advantage, they can then engage in international trade. By trading the goods and services they excel at producing, countries can acquire products from other nations that they are relatively less efficient in producing themselves. This mutual exchange based on comparative advantage leads to a more efficient allocation of global resources, enhanced productivity, and increased overall economic welfare. By embracing comparative advantage and engaging in international trade, countries can achieve higher levels of production and consumption compared to a scenario where each country tries to produce everything domestically. The gains from trade are realized through increased efficiency, expanded market access, and the ability to benefit from the diverse capabilities and resources of different countries. As a result, all participating countries can experience improved standards of living and economic prosperity. In essence, the concept of comparative advantage provides a solid foundation for understanding why countries engage in international trade and how specialization and exchange based on individual strengths can lead to collective benefits for all nations involved. 3. Factors influencing international trade, understanding imports and exports. International trade is influenced by a multitude of factors that shape the level and dynamics of import and export activities. These factors can be categorized into two main aspects, those affecting imports and those affecting exports. Factors affecting imports. Imported goods are influenced by several key factors. 1. Consumer preferences. Consumer demand plays a significant role in driving imports. Preferences for certain imported goods, such as unique or high-quality products, can lead to increased imports in specific sectors or industries. 2. Domestic production levels. The extent of domestic production affects import levels. If domestic production is limited or unable to meet the demand, imports may rise to bridge the supply gap. 3. Availability of substitutes. The availability and competitiveness of domestic substitutes influence import levels. If suitable substitutes are scarce or more expensive to produce domestically, imports may increase. 4. Government policies. Import tariffs, quotas, and other trade policies imposed by governments significantly impact import levels. Tariffs, for instance, increase the cost of imports, while quotas restrict the quantity of imported goods. Factors affecting exports. Export activities are influenced by various factors. 1. Factors of production. The availability and quality of factors of production, including labor, capital, and natural resources, affect a country's export potential. Abundant resources and skilled labor can enhance a country's ability to produce and export goods. 2. Technological capabilities. Technological advancements and innovation contribute to a country's export competitiveness. Advanced technology enables higher productivity, better product quality, and innovation, which can boost exports. 3. Production costs. The cost of production, including labor, raw materials, and overhead expenses, impacts a country's export competitiveness. Lower production costs make exports more attractive in global markets. 4. Government export promotion policies. Governments may implement policies to support and promote exports. These policies can include financial incentives, export subsidies, trade agreements, and diplomatic efforts to expand market access for domestic goods and services. Understanding and considering these factors helps policymakers, businesses, and economists analyze and predict the patterns and trends in international trade. By recognizing the various influences on imports and exports, countries can develop strategies to enhance their competitiveness, foster trade relationships, and optimize their participation in the global marketplace. 4. Terms of trade. Understanding exchange ratios in international trade. The terms of trade reflect the exchange ratio at which a country can trade its exports for imports. It quantifies the purchasing power of a country's exported goods and services in relation to the cost of its imported goods and services. Improvements in terms of trade occur when the prices of a country's exports increase compared to the prices of its imports. This shift in relative prices can have several implications for the country's economy. The terms of trade play a crucial role in determining a country's ability to acquire imports in exchange for its exports. When a country experiences an improvement in terms of trade, it means that it can obtain a greater quantity of imports for the same amount of exported goods. This is because the rise in export prices allows the country to generate more revenue from its exports, which can then be used to purchase a larger volume of imports. The benefits of improved terms of trade are multifold. First, it enhances a country's purchasing power, as it can import a greater variety and quantity of goods and services. This leads to an expansion of the available consumer choices and can contribute to higher standards of living. Additionally, improved terms of trade can stimulate economic growth by facilitating the acquisition of capital goods and technology through imports. These resources can enhance productivity, competitiveness, and overall economic development. By gaining access to more advanced technology or machinery, a country can improve its production capabilities and potentially increase the value and quality of its exports. However, it is important to note that the impact of changes in terms of trade is not uniform across all sectors and industries. Different sectors may have varying levels of exposure to international trade, and changes in relative prices can affect them differently. Sectors that heavily rely on exports may experience significant benefits from improved terms of trade, while sectors dependent on imports may face challenges due to higher import costs. Monitoring and analyzing the terms of trade is essential for policymakers and economists as it provides insights into a country's trading position and economic performance. Understanding the dynamics of terms of trade can help guide policy decisions related to trade, exchange rates, and economic development strategies. 5. Factors influencing exchange rates. Understanding currency valuation. The level of an exchange rate, which determines the value of a currency in relation to another currency, is influenced by a multitude of factors. These factors collectively shape the supply and demand dynamics in the foreign exchange market and impact the relative value of currencies. Understanding these influences is crucial for comprehending currency valuation and the dynamics of exchange rates. Supply and demand in the foreign exchange market. The exchange rate of a currency is primarily driven by the forces of supply and demand in the foreign exchange market. When the demand for a currency increases relative to its supply, its value tends to appreciate. Conversely, if the supply surpasses the demand, the currency's value may depreciate. The supply and demand for a currency are influenced by a range of factors. 1. Interest rates. Differentials in interest rates between countries can affect exchange rates. Higher interest rates tend to attract foreign investors, leading to increased demand for the currency, and potentially causing it to appreciate. Conversely, lower interest rates may decrease demand for the currency, potentially leading to depreciation. 2. Inflation rates. Disparities in inflation rates between countries can impact exchange rates. Countries with lower inflation rates tend to experience stronger currency values, while those with higher inflation rates may see depreciation. 3. Government policies. Monetary and fiscal policies implemented by governments, such as adjustments in interest rates, money supply, or taxation, can influence exchange rates. For instance, tightening monetary policy to control inflation may result in currency appreciation, while expansionary policies aimed at stimulating economic growth may lead to depreciation. 4. Economic indicators. Economic indicators, including GDP growth, employment rates, trade balances, and productivity, provide insights into a country's economic health. Positive indicators can attract foreign investors and contribute to currency appreciation. 5. Market expectations. Exchange rates are also influenced by market participants' expectations of future economic and political developments. Speculation, investor sentiment, and geopolitical events can all shape market expectations, leading to fluctuations in exchange rates. These factors interact in complex ways, and their influence on exchange rates is dynamic and interdependent. Additionally, the foreign exchange market operates 24 hours a day, allowing for continuous trading and immediate response to changing circumstances, which further contributes to exchange rate fluctuations. Monitoring and analyzing these factors helps policymakers, businesses, and investors make informed decisions regarding currency exchange, international trade, and investment strategies. Additionally, understanding the factors influencing exchange rates is vital for managing risks associated with currency fluctuations in global markets. 6. Exchange rate regimes. Understanding systems of exchange rate determination. Exchange rate regimes encompass the systems or frameworks that govern how exchange rates are determined in a country. These regimes establish the rules and mechanisms that shape the value of a currency relative to other currencies. Different exchange rate regimes exist, each with its own characteristics, advantages, and implications for the economy. Fixed exchange rate regimes, stability through government control. Fixed exchange rate regimes involve establishing a fixed or pegged exchange rate for a country's currency. The government or central bank actively sets and maintains the exchange rate by intervening in the foreign exchange market. This intervention typically involves buying or selling currencies to ensure the exchange rate remains within the predetermined band. Fixed exchange rate regimes provide stability and predictability for businesses and investors, as they know the exact value of the currency in relation to other currencies. However, maintaining a fixed exchange rate requires significant foreign exchange reserves and may limit a country's ability to independently conduct monetary policy. Floating exchange rate regimes, market forces at play. Floating exchange rate regimes allow the value of a currency to be determined by market forces of supply and demand in the foreign exchange market. Under this system, the exchange rate fluctuates freely based on economic fundamentals, market expectations, and other factors influencing currency demand and supply. Floating exchange rates provide flexibility and automatic adjustment mechanisms. They enable currencies to reflect changes in economic conditions, such as inflation, interest rates, and trade imbalances. However, floating exchange rates can also lead to volatility and uncertainty, which can pose challenges for businesses engaged in international trade and investment. Managed exchange rate regimes, a hybrid approach. Managed exchange rate regimes combine elements of both fixed and floating exchange rates. In this system, market forces play a role in determining the exchange rate, but government intervention is also present to influence or manage the exchange rate within a certain range or band. Governments may employ various measures, such as buying or selling currencies, implementing capital controls, or adjusting monetary policies, to guide the exchange rate towards desired levels. Managed exchange rate regimes aim to balance the benefits of market flexibility with the advantages of stability and control provided by fixed exchange rates. They can be seen as a compromise between the extremes of fixed and floating exchange rate regimes. The choice of exchange rate regime depends on various factors, including a country's economic goals, external trade relationships, monetary policy objectives, and the level of exchange rate stability desired. Governments and central banks carefully consider these factors when determining the most appropriate exchange rate regime for their country's economic circumstances. 7. Appreciation and depreciation, impact on currency value and international trade. Appreciation and depreciation are terms used to describe the changes in the value of a currency relative to other currencies in the foreign exchange market. These fluctuations have important implications for international trade, as they affect the cost of imports and exports. Appreciation, strengthening currency value. Appreciation refers to an increase in the value of a currency relative to other currencies. When a currency appreciates, it can purchase a larger amount of foreign currency. This means that the value of imports denominated in foreign currency becomes relatively cheaper for the country experiencing currency appreciation. On the other hand, exports become more expensive in terms of foreign currency, potentially reducing the competitiveness of domestically produced goods and services in international markets. The impacts of currency appreciation can be significant. Cheaper imports resulting from an appreciating currency can benefit consumers by offering a wider range of affordable imported goods and potentially reducing domestic inflationary pressures. However, it can also pose challenges for exporters, as higher export prices may lead to reduced demand and decreased competitiveness in foreign markets. Depreciation, weakening currency value. Depreciation, in contrast, refers to a decrease in the value of a currency relative to other currencies. A depreciating currency means that it can buy less foreign currency. This leads to an increase in the cost of imported goods and services for the country with the depreciating currency. Conversely, exports become relatively cheaper in terms of foreign currency, potentially boosting the competitiveness of domestically produced goods and services in international markets. Depreciation can have both positive and negative effects. On the positive side, it can support export-oriented industries by making their goods and services more price competitive in foreign markets. This can lead to increased export revenue, job creation, and economic growth. However, it can also result in higher prices for imported goods, potentially increasing inflationary pressures and reducing the purchasing power of consumers. Currency appreciation and depreciation are influenced by a range of factors, including supply and demand dynamics in the foreign exchange market, interest rates, inflation rates, economic indicators, government policies, and market expectations. These factors interact in complex ways and can lead to fluctuations in exchange rates and currency values. Understanding the effects of currency appreciation and depreciation is crucial for businesses engaged in international trade, policymakers shaping economic and trade policies, and individuals involved in currency exchange. Monitoring and analyzing these fluctuations helps stakeholders make informed decisions and manage the risks and opportunities associated with currency value changes. 8. Exchange rate devaluation and revaluation, intentional adjustments to currency value. Exchange rate devaluation and revaluation are deliberate adjustments made by a government or central bank to alter the value of a currency in relation to other currencies. These adjustments are aimed at achieving specific economic objectives and can have significant implications for a country's trade competitiveness, inflation, and overall economic stability. Exchange rate devaluation, lowering currency value. Exchange rate devaluation involves an intentional downward adjustment of a currency's value in relation to other currencies. This adjustment is typically carried out by the government or central bank. Devaluation can be achieved through various measures, including reducing the official exchange rate, increasing the supply of domestic currency in the foreign exchange market, or implementing monetary policies that decrease the demand for the currency. The purpose of devaluation is often to enhance a country's trade competitiveness. By lowering the value of its currency, a country's exports become relatively cheaper for foreign buyers, potentially leading to an increase in export demand. This can boost the country's export revenue, stimulate economic growth, and help address trade imbalances. However, devaluation can also lead to higher import costs, which may contribute to inflationary pressures and impact domestic consumers. Exchange rate revaluation, raising currency value. In contrast, exchange rate revaluation involves an intentional upward adjustment of a currency's value. Revaluation can be implemented by the government or central bank through various measures, such as increasing the official exchange rate or implementing policies that decrease the supply of domestic currency in the foreign exchange market or increase its demand. The objective of revaluation is often to address certain economic considerations. It can be used to curb inflationary pressures, reduce import costs, enhance the purchasing power of domestic consumers, or stabilize the economy. Revaluation can make imports relatively cheaper, benefiting consumers by lowering the prices of imported goods. However, it may also make exports more expensive, potentially reducing export competitiveness and trade volume. Government and central bank authorities carefully consider the potential impacts and trade-offs associated with exchange rate devaluation and revaluation. These adjustments can have far-reaching consequences for the economy, including affecting trade balances, inflation rates, investment flows, and overall economic stability. It is essential for policymakers to weigh the benefits and risks when making decisions regarding intentional adjustments to currency value. Monitoring and understanding the objectives and effects of exchange rate devaluation and revaluation are crucial for businesses engaged in international trade, investors, and policymakers. This knowledge helps stakeholders navigate the economic landscape, manage risks, and seize opportunities associated with changes in currency value. 9. Understanding the balance of payments and balance of trade. The balance of payments, a holistic view of international transactions. The balance of payments provides a comprehensive record of all economic transactions between a country and the rest of the world over a specific period. It captures the inflows and outflows of funds resulting from international trade in goods, services, capital, and financial activities. The balance of payments reflects the interactions between a country's residents and non-residents, encompassing various accounts that track different types of transactions. Components of the balance of payments. The balance of payments consists of three main accounts: the current account, the capital account, and the official financing account. 1. Current account, tracking trade and services. The current account records the transactions related to trade in goods, services, income, and unilateral transfers. It includes the balance of trade, which is a component of the current account. The balance of trade specifically measures the difference between the value of a country's exports and imports of visible, tangible, and invisible services, goods. A positive balance of trade, known as a trade surplus, indicates that a country's exports exceed its imports, while a negative balance, known as a trade deficit, implies the opposite. 2. Capital account, monitoring capital transfers. The capital account captures capital transfers and the acquisition or disposal of non-financial assets. It tracks transactions involving assets such as real estate, patents, copyrights, and non-produced, non-financial assets. Capital transfers can include gifts, inheritances, and debt forgiveness, among other forms of capital flows. 3. Official financing account, assessing international financial assistance. The official financing account represents the financial assistance provided to or received by a country from international organizations, such as the International Monetary Fund, IMF, or other governments. It includes loans, grants, and other official transfers that are often used to support economic development, stabilize financial markets, or address balance of payments issues. By examining the balance of payments, policymakers, economists, and analysts can gain insights into a country's economic relationships with the rest of the world. It helps assess the overall financial health, trade competitiveness, and external stability of a nation's economy. Understanding the balance of payments and its components, including the balance of trade, is crucial for policymakers to formulate effective economic policies, identify potential imbalances, and assess the overall economic performance of a country in the global context. 10. Components of the balance of payments account. Tracking international transactions. The balance of payments account is a comprehensive record that captures various entries representing different types of international transactions. These entries provide insights into a country's economic interactions with the rest of the world, encompassing a wide range of activities and flows of funds. Exports and imports, trade in goods and services. Exports and imports of goods and services form a crucial component of the balance of payments account. Exports represent the value of goods and services produced domestically and sold to foreign markets. They contribute to a country's economic growth and generate revenue. Imports, on the other hand, signify the value of goods and services purchased from abroad and consumed domestically. The balance between exports and imports directly influences the balance of trade, which is a component of the current account within the balance of payments. Income from abroad, profits, interest, and dividends. Income from abroad refers to the earnings and payments associated with factors of production, including profits, interest, dividends, and wages earned by individuals, businesses, and investors in foreign countries. This income is often derived from foreign direct investments, where entities from one country establish operations or make investments in another country. Income from abroad is accounted for in the balance of payments, contributing to the overall balance of current account transactions. Foreign direct investment, cross-border capital flows. Foreign direct investment, FDI, represents investments made by individuals, businesses, or governments from one country into productive assets located in another country. These investments typically involve long-term commitments and ownership stakes in companies, real estate, infrastructure, or other ventures. FDI contributes to the capital account of the balance of payments, reflecting the inflows and outflows of capital between countries. Official reserve transactions, central bank operations. Official reserve transactions involve the activities of a country's central bank or monetary authority to manage and hold foreign currency reserves. These transactions include purchases or sales of foreign currencies, gold, or other reserve assets. Central banks engage in reserve transactions to influence their currency's exchange rate, maintain stability in financial markets, or address balance of payments imbalances. Foreign aid, international financial assistance. Foreign aid comprises financial transfers provided by one country or international organizations to another country for development projects, humanitarian relief, or other purposes. These transfers are recorded as inflows in the balance of payments account and contribute to the official financing account. By including these various entries, the balance of payments account provides a comprehensive picture of a country's economic transactions with the rest of the world. It helps policymakers, economists, and analysts assess the economic health, financial stability, and external relationships of a nation. Analyzing the components of the balance of payments account allows for a deeper understanding of cross-border trade, investments, income flows, and international financial assistance. 11. Balance of payments surpluses and deficits, understanding currency flows. Balance of payments surpluses, excess receipts and foreign currency. Balance of payments surpluses occur when the total receipts from international transactions exceed the payments. In other words, a surplus signifies that a country has received more foreign currency than it has paid out. This excess of foreign currency is typically reflected in the country's foreign exchange reserves. Surpluses can result from various factors, such as strong export performance, higher income from investments abroad, or inflows of foreign aid or capital. Having a balance of payments surplus can bring certain advantages. It indicates a favorable position in international transactions, as the country is receiving more value from its exports, investments, or other sources than it is spending on imports, payments to foreign investors, or other outflows. Surpluses can contribute to the accumulation of foreign exchange reserves, which can enhance a country's ability to meet international payment obligations, stabilize its currency, and provide a cushion during periods of economic uncertainty. Balance of payments deficits, shortage of foreign currency. Conversely, balance of payments deficits occur when the payments made by a country exceed the receipts from international transactions. This results in a shortage of foreign currency and can lead to challenges in meeting international payment obligations. Deficits can arise due to factors such as high levels of imports, lower export earnings, outflows of capital or investment, or debt repayments. Balance of payments deficits can have implications for the economy. They indicate an imbalance in international transactions, as the country is spending more on imports or other outflows than it is receiving from exports or other inflows. Deficits may put pressure on a country's foreign exchange reserves and currency value, potentially leading to currency depreciation. A sustained deficit can indicate underlying issues in competitiveness, trade imbalances, or economic vulnerabilities. Monitoring and managing balance of payments surpluses and deficits is crucial for policymakers to ensure economic stability and sustainable development. Countries strive to maintain a balance or manage their imbalances to mitigate potential risks and promote economic growth. Strategies to address deficits may involve measures to boost exports, attract foreign investment, reduce import dependence, or improve competitiveness. Surpluses, on the other hand, require careful management to avoid currency appreciation, maintain competitiveness, and utilize the surplus effectively for economic development and resilience. 12. Factors contributing to balance of payments surpluses and deficits. Factors leading to balance of payments surpluses. Balance of payments surpluses can be attributed to various factors that contribute to a country's favorable position in international transactions. 1. Strong export performance. Robust exports, driven by competitive industries, high-quality products, or unique offerings, can generate higher receipts from foreign buyers. Increased export earnings contribute to a balance of payments surplus. 2. High levels of foreign investment. Inflows of foreign direct investment, FDI, or portfolio investment can boost a country's capital account and contribute to a balance of payments surplus. Foreign investors bring in funds, technological expertise, and managerial skills, stimulating economic growth and generating receipts for the country. 3. Positive income from abroad. Income earned from investments, profits, dividends, or royalties received from abroad can contribute to a balance of payments surplus. This income from foreign assets or businesses generates receipts for the country. 4. Inflows of foreign aid. Financial assistance provided by other countries or international organizations in the form of grants, loans, or other aids can increase receipts and contribute to a balance of payments surplus. Foreign aid supports development projects, addresses social needs, or assists in times of crisis. Factors leading to balance of payments deficits. Balance of payments deficits can arise due to various factors that contribute to a country's unfavorable position in international transactions. 1. Trade imbalance. When a country's imports exceed its exports, it leads to a trade imbalance, contributing to a balance of payments deficit. Factors such as limited domestic production, high reliance on imported goods, or weak competitiveness in global markets can contribute to this trade imbalance. 2. High levels of imports. Increased demand for imported goods and services can result in higher payments, creating a balance of payments deficit. Factors such as consumer preferences, lack of domestic substitutes, or inadequate production capacity can drive imports. 3. Capital outflows. When a country experiences significant outflows of capital, such as investments abroad or debt repayments to foreign entities, it contributes to a balance of payments deficit. These outflows reduce the country's foreign currency reserves and result in a shortage of foreign currency. 4. Negative income from abroad. if a country's residents or businesses earn less from their investments or assets held abroad compared to the payments made to foreign investors, it leads to negative income from abroad. This negative income contributes to a balance of payments deficit. 5. Debt repayments. Repaying foreign debts or servicing interest payments on outstanding loans can create additional outflows of foreign currency, contributing to a balance of payments deficit. Understanding these factors that give rise to balance of payments surpluses and deficits helps policymakers identify areas of focus to promote economic stability, address trade imbalances, attract investments, and manage external vulnerabilities. 13. Implications of balance of payments surpluses and deficits. Consequences of balance of payments surpluses. Balance of payments surpluses can have various implications for an economy, including 1. Accumulation of foreign reserves. Surpluses often result in the accumulation of foreign currency reserves, which can strengthen a country's ability to meet international payment obligations and maintain financial stability. Foreign reserves act as a buffer during economic downturns, providing a cushion against external shocks and supporting confidence in the economy. 2. Appreciation of the currency. A sustained balance of payments surplus can lead to upward pressure on the country's currency exchange rate. Currency appreciation can make imports relatively cheaper and increase the purchasing power of domestic consumers. However, it can also pose challenges for export-oriented industries by making their products comparatively more expensive in foreign markets. 3. Increased imports. Surpluses may lead to higher domestic purchasing power, encouraging increased imports of goods and services. This can provide consumers with a wider range of choices, access to new technologies, and potential improvements in living standards. 4. Potential risks of export dependency. Over-reliance on exports due to sustained surpluses can expose an economy to risks associated with fluctuations in global demand, changes in trade policies, or shifts in competitive advantages. It highlights the importance of diversifying the economy and nurturing other sectors to reduce vulnerability to external shocks. Consequences of balance of payments deficits. Balance of payments deficits can also have significant implications for an economy, including 1. Depletion of foreign reserves. Prolonged deficits can deplete a country's foreign currency reserves, potentially limiting its ability to meet international payment obligations and increasing vulnerability to financial crises or market uncertainties. 2. Depreciation of the currency. Deficits can exert downward pressure on a country's currency exchange rate, leading to currency depreciation. Currency depreciation can make imports relatively more expensive, potentially contributing to higher domestic inflation and reduced purchasing power of consumers. 3. Reduced imports. Deficits may necessitate measures to curtail imports, which can have an impact on domestic consumers, industries reliant on imported inputs, and access to certain goods and services. Reducing imports can also be a strategy to address trade imbalances and improve the current account. 4. Potential risks to economic stability. Sustained deficits can raise concerns about a country's ability to finance its external obligations and maintain economic stability. It may signal structural issues, such as low competitiveness, insufficient export diversification, or imbalances in the economy that need to be addressed to restore a sustainable external position. Monitoring and managing balance of payments surpluses and deficits is crucial for policymakers to ensure economic stability, sustainable growth, and resilience. Maintaining a balanced approach, addressing underlying factors contributing to imbalances, and implementing appropriate policies are important for mitigating risks and maximizing the benefits associated with a country's external position. 14. Remedies for balance of payments surpluses and deficits. Possible remedies for balance of payments surpluses. When a country experiences a balance of payments surplus, several remedies can be considered to manage the situation effectively. 1. Implementing contractionary fiscal or monetary policies. Contractionary fiscal or monetary policies aim to reduce domestic demand and discourage excessive imports. These measures may involve reducing government spending, increasing taxes, tightening monetary policy, or raising interest rates. By reducing domestic demand, the country can help align its economic activity with the level of its exports and avoid excessive reliance on external demand. 2. Promoting imports. Encouraging imports can help address a balance of payments surplus by stimulating domestic consumption and diversifying the range of available goods and services. Reducing trade barriers, such as tariffs or quotas, can facilitate greater imports, expanding consumer choices and potentially reducing trade imbalances. 3. Encouraging capital outflows. Encouraging domestic investors to invest in foreign markets or facilitating outward foreign direct investment, FDI, can help mitigate a balance of payments surplus. Capital outflows can balance the inflows and reduce pressure on the country's currency. However, careful consideration must be given to the risks associated with capital outflows and the impact on the domestic economy. 4. Investing abroad. Investing abroad through sovereign wealth funds or other investment vehicles can diversify a country's asset holdings and generate income from foreign sources. This can help reduce reliance on domestic demand and balance the capital account of the balance of payments. Possible remedies for balance of payments deficits. When a country experiences a balance of payments deficit, several remedies can be considered to address the situation effectively. 1. Implementing expansionary fiscal or monetary policies. Expansionary fiscal or monetary policies aim to stimulate domestic demand and economic activity, which can contribute to increased exports and reduce trade imbalances. These policies may involve increased government spending, tax cuts, loosening monetary policy, or reducing interest rates to encourage investment and consumption. 2. Promoting exports. Supporting and promoting export-oriented industries through targeted policies, export incentives, market diversification, and investment in research and development can enhance a country's export competitiveness. This can help boost export earnings and narrow the trade deficit. 3. Attracting capital inflows. Encouraging foreign direct investment, FDI, portfolio investments, or loans from foreign sources can help finance the balance of payments deficit. Attracting capital inflows can increase foreign exchange reserves, support economic growth, and help address external financing needs. However, managing risks associated with capital inflows and ensuring their alignment with long-term economic goals is essential. 4. Seeking financial assistance from international organizations. In cases of significant balance of payments deficits, countries may seek financial assistance from international organizations such as the International Monetary Fund, IMF, or regional development banks. These organizations can provide loans, technical assistance, or policy guidance to help stabilize the economy, address imbalances, and restore external viability. It is important for policymakers to carefully assess the appropriateness and potential impacts of these remedies based on their country's specific circumstances, economic goals, and long-term sustainability. A comprehensive and coordinated approach that addresses structural issues, enhances competitiveness, promotes trade diversification, and fosters sustainable economic growth is often necessary to effectively manage balance of payments imbalances. 15. The role and functions of the World Trade Organization, WTO, in global trade. The World Trade Organization, WTO, is an international organization dedicated to governing and regulating the rules of trade among nations. It serves as a forum for member countries to negotiate and establish agreements aimed at promoting fair and open international trade. The WTO plays a vital role in facilitating global trade, ensuring a level playing field for businesses, resolving trade disputes, and fostering economic growth. Ensuring the smooth flow of international trade. One of the primary functions of the WTO is to facilitate the smooth flow of international trade. It achieves this by providing a platform for negotiations and agreements that establish rules and guidelines for conducting trade. These rules cover a wide range of areas, including tariffs, non-tariff barriers, subsidies, intellectual property rights, and services trade. By promoting transparency, predictability, and stability in global trade, the WTO helps reduce uncertainty and promote confidence among traders. Promoting fair competition. The WTO strives to promote fair competition in international trade. It aims to prevent discriminatory practices, such as unfair trade subsidies or trade-distorting measures, that can undermine the principles of open and fair competition. Through its agreements and monitoring mechanisms, the WTO encourages member countries to adhere to fair trade practices and create an environment conducive to healthy competition and market access. Settling trade disputes. The WTO has a crucial role in resolving trade disputes between member countries. It provides a formal dispute settlement mechanism that allows countries to bring forward their grievances and seek resolution through a rules-based system. This process involves consultations, panel hearings, and appellate reviews. The objective is to ensure that trade disputes are settled impartially and based on the established rules and principles of the WTO, fostering stability and predictability in international trade relations. Platform for negotiations on trade liberalization. The WTO serves as a platform for negotiations on trade liberalization among member countries. Through rounds of negotiations, such as the Doha Development Agenda, the WTO seeks to lower trade barriers, enhance market access, and promote economic integration. These negotiations aim to strike a balance between the interests of developed and developing countries, addressing developmental concerns and fostering inclusivity in global trade. Promoting economic growth and reducing trade barriers. By promoting fair and open trade, the WTO contributes to economic growth and development worldwide. Its focus on reducing trade barriers, such as tariffs and non-tariff measures, helps expand market opportunities for businesses, particularly in developing countries. By fostering a predictable and transparent trading environment, the WTO encourages investments, boosts productivity, and supports job creation. In summary, the World Trade Organization plays a vital role in facilitating and regulating international trade. Through its functions of ensuring the smooth flow of trade, promoting fair competition, settling disputes, and providing a platform for negotiations, the WTO promotes economic growth, reduces trade barriers, and fosters a rules-based system that benefits all member countries.